Good morning and welcome to today's webinar from East Capital Group here in Stockholm. My name is Marcus Rågmark and I work as part of the investor relations team here at East Capital Group. Today's webinar will focus on a topic which is currently very widely discussed in the asset management industry, and that is the topic of whether to classify a fund as Article 8 or Article 9. And simply put, this is a way of ranking how sustainable a fund's investments are, where Article 9 essentially is the most sustainable fund of its kind. At East Capital Group, we're very proud today to be running two Article 9 funds in the group. So what are these two Article 9 funds? One is our Global Emerging Markets strategy, under our East Capital brand. So this fund is called East Capital Global Emerging Markets Sustainable. And of course, as an Article 9 fund, has a very thorough and extensive ESG integration process. And we were very proud last year to be highlighted by the UN PRI in one of their case studies, sort of highlighting our SDG integration tool, which is a proprietary tool for how to integrate the Sustainable Development Goals into emerging market investments. So as I mentioned, very proud of this, and this provided external validation of the sort of leading work we're doing on the ESG front in emerging market investments. But not only that, an important point to stress as well is that the emerging market strategy has performed exceptionally well and provided more than 30 percentage points of alpha since its inception some 4 years ago, which puts us in the very, very top percentile among all global emerging markets funds, not only Article 9 funds. So what do I want to stress with this? I think it's important just to mention that this supports the point that sustainable investments don't actually sacrifice financial returns, but rather they enhance them, as we show through this emerging market strategy. Our second Article 9 fund is through our Espiria brand, which is more focused on developed market equities. This fund is called Espiria SDG Solutions and is run by Huizi Zeng, who I'm very glad to have with us on link here today on the ground in Asia. So welcome, Huizi.
Thank you, Marcus. Good morning, everyone.
And before we dive in, I would just like to remind all our viewers to please share any questions that you may have. In the right-hand side of your screen, you have a Q&A function. So please do share any questions and we'll do our very best to answer them in the next 20 minutes or so. So with that, I think we'll dive right in. And just to provide some context on sort of the scale of the issue here, we've seen only in Q4 last year alone 307 funds downgrade from Article 9 to Article 8, totaling some 140 billion euros of AUM. So Huizi, can you just share a bit your thoughts regarding why there have been such a large wave of downgrades?
Absolutely. I think the downgrades we've seen in the fourth quarter last year is mainly due to two likely reasons. First of all, when you look at the data, you notice that over 40% of the 307 funds downgraded were passive funds, and nearly all of which are actually ETF tracking Paris aligned or climate transition benchmarks, the so-called PABs and CDBs. So while these PABs and CDB invest in companies with progressively lower emissions, the firms that these funds hold cannot be considered inherently sustainable. At least we haven't seen any explicit clarification from the European Commission saying that these funds do qualify as Article 9. And this also is not a big surprise really, because last year in July, we already heard that global head of sustainability at Morningstar already warned that these funds tracking climate benchmarks could lose their Article 9 status. So that's a most obvious reason why we're seeing so many funds downgrading in the fourth quarter. But of course, the other more than half of the funds downgraded were also active funds, like we ourselves are. I think the main reason there is clearly, when you look at Article 9 SFDR regulation requirements, it's fairly stringent, and it clearly demands much more than what the traditional mainstream ESG integration approach would entail. So I think it's likely that many funds with traditional ESG integration approach find it fairly hard to fulfill the disclosure requirements without changing its investment strategy or process. And plus that we had at the end of the year a level 2 disclosure with a lot of details that's needed. So I think these two are the main reasons behind the recent many downgrades. But to be fair, of course, the first deadline for classification came about before the technical requirements were available. So there were space for interpretation, and there requires as a manager to take a sort of leap of faith. In many cases, it was not possible to keep but it's not possible to keep the classification if you have not done the homework.
Right, makes sense. And in terms of the fund you're running, Espiria SDG Solutions, can you elaborate to our viewers sort of what makes you as confident as you are in its Article 9 classification?
Yeah, so we are very comfortable with our Article 9 classification, given our strategy and investment process, which enable us to deliver actually even one step further than the Article 9 requirements, in my view, in such a way that it provides us with some sort of buffer, which is nice to have. What do I mean by buffer? How do we achieve that? I think it's probably worth to go, back into history a bit on when we set the Espiria SDG Solution Fund strategy back in 2021. We started with very high ambition because we wanted to be a front runner and role model of public equity investing with impact. Back then, what we saw was that in the market, there was a lot of confusion around sustainability-related terminologies due to a lack of consistent standard or definition. We also were very much aware of the existence of sustainability washing or SDG washing in the market. And we were very positive when we saw that EU has an effort to reduce such phenomena through the regulations. But we did not just want to carry out our work merely for the regulation compliance purpose. So we had a very strong intention to create a fund that truly address sustainability issues in reality now and for our future generations, alongside attractive long-term financial gains. So we designed our process in the way that ensure investment selection contributed as these targets with real-world outcomes that can be very well justified and measured. So this involves a lot of work behind, but we're really glad to see the progress so far. And meanwhile, we do this process. We do notice that the solid investment process resonates very well with SFDR as the regulation itself actually is still evolving and with increasing clarity. On this slide that you're seeing, it shows basically how we do it exactly. And then that SFDR sustainable investment is pretty much defined by three criteria. We can maybe quickly go through that. So contribution, number one criterion, contribution to an environmental or social objective. It needs to be very clear and very specific first. So in our proprietary process, we have this so-called tool called EAI, where we define a selected 48 investable SDG targets out of 169 of them. And that is our starting point to screen and select stocks. And depending on which SDG target it addresses, every investment falls under one of our 5 broad SDG themes. So I think the learnings here is that ability to be very specific on what sustainability targets we're addressing enable us to take a very careful assessment on the causal relationship between our investee companies and certain sustainability goal. And when you look at SFDR requirements, it made us super easy to classify which investment was meant to achieve an E or S objective, and also help us to be able to monitor the minimum requirements. And besides, we actually only look at one primary material SDG target a company addresses. So the SDGs contributions, they cannot be simply aggregated to appear artificially high, like many companies would report themselves. So instead, we calculate the actual SDG contributions at the holding level to quantify the real level. And most of our holdings today in portfolio are either pure play or decisive play, which means at least 80% or 50% of the revenue directly addressing one primary SDG target. And at the portfolio level, then we could aggregate and calculate the weighted SDG solution percentage, which is also what we use as one of the sustainability indicators that is required in disclosure by SFDR. Yeah, so and the second step here is, I think we took actually one step forward in justifying, as I mentioned earlier, in each investment's contribution, measuring the outcomes, considering the company's accountability, and also looking into the major adverse impacts and mitigating efforts that be taken by the company. These are all done by our EAI tool, which is a set of 28 assessment questions designed to reflect the essence of the 5 dimensions of impact. So you see here the tools are pretty comprehensive. We also have EQSS that help us to assess company holdings, which also allows us to answer questions on do no significant harm, governance, and also consideration of PAIs.
Great. Thanks, Huizi, for that very thorough explanation and run through. Indeed, a very solid investment process. So would you say that Espiria SDG Solutions and other Article 9 funds for that matter, through their exposure to these sustainable themes and structural growth trends, have a better chance to outperform their peers on a sort of midterm basis moving forward?
Yeah, we very much believe that having exposure to various sustainable themes do imply very attractive growth opportunities that can be materializing in mid to long term. And even if we were just close enough to achieve the SDG 2030 goals, and the growth trajectory would already be very, very attractive, as you could see in the maybe next slide here. I want to show you some examples here. So as you see here, these are the representative thematic tailwinds that we see across our portfolio. Clearly, it demonstrates above economic, broad growth opportunities here. No matter which theme or sub-theme we're looking at here, it could be as high as over 30%, or it could be double digits or mid-teens, and so on. So these growth paths, in our view, are to be less affected by the short-term cycles that we are currently in, and therefore provides a resilience on top of the long-term growth trajectories here. So when Marcus, you're talking about our performance, I think it's also equally important on how we select companies, given the exposure on these themes. Choose the right companies and invest in the right time. We do have proprietary tools that help us to select companies in a consistent way. So as you see here on this next slide here, as one example, when we're talking about the sub-theme, green mobility, yes, it's a clearly a quite high growth market. And since we are agnostic on region or sector, we're able to select the company, most attractive company or stocks along the value chain, following our themes and sub-themes. And generally, we like companies that could turn ESG risks into new business opportunities, and they demonstrate leadership in doing so. And we tend to select, in particular, those companies whose positive environmental and social impact can be well justified and measured.
Great. So once again, I think this emphasizes the point that indeed sustainable investments and financial returns don't need to be mutually exclusive, but on the contrary, actually one sort of feeds the other, if you will. So Huizi, I guess to summarize, what would you say are sort of the 3 key defining elements of running an Article 9 fund, and what makes you sort of most excited about running a fund like Espiria SDG Solutions?
Yeah, so in our view, what are the defining elements of Article 9 fund? I think it's firstly, the fund needs to be fully committed into sustainable investment, because the portfolio is only allowed to make the sustainable investment in the regulations criteria. And secondly, I think it needs to have very clear intention to deliver meaningful contribution to sustainable goals, and the investment process needs to provide further details as evidence. We need to be very specific on what and how, and also with measured progress. And lastly, defining elements could be that we need to ongoing monitor our asset allocation commitment, and we make sure that selective investments performance on sustainability is continuously tracked. So that's that. What I'm excited about. For me, I think number one has to be that it's very exciting to be able to help our investors achieve growth in a way that is future-proof. That's super motivating for us. For me, at a personal level, it also feels that values are aligned through what I do in our daily work, and we invest in the future together for our next generations in the world where they're going to live in as well. And second thing would be that this fund is really, the goal is to show that positive sustainability outcomes could be achieved together with attractive financial gains, rather that we don't believe that there is a trade-off in between, rather that these two enhance each other when the strategy is correctly set, and the investment process ensures that the selections are made to identify the companies that do turn this, identify the same relationship as we see between the two factors. And lastly, of course, it's also to our joy, and it's exciting to follow the progress of the EU regulation. Our fund's process resonates really well with the SFDR's intention, the principles, and that gives us confidence that even as the regulation evolves going forward, we will deliver with comfort.
Great, thanks, Huizi, and that sounds like a good recipe for continued success then. I'm really glad to see that we've received a number of questions here from our viewers over the past 20 minutes. I'm afraid we won't have time to go through all of them, but most questions seem to be relating to your views on how Espiria SDG Solutions sort of targets certain SDG targets more than others, or is it sort of evenly mixed?
Yeah, so we do target, as I mentioned, 48 SDG targets out of 169, and these are the target levels, so not goals. At the goal level, when they were out of 17, we invest in 12 of them, because the remaining 5 we believe are not investable through products and services as solutions. So I think we target these areas, don't mean that we equally allocate weight among all of them. When you look at portfolio breakdown, we have certainly the largest theme is related to connectivity and infrastructure, and that's including a lot of the concepts I showed you just now in the sub themes. It's industrial, retrofit, and upgrading, and also the second biggest sub theme would be energy transitions. That includes both supplies and also energy efficiency solutions. And then we also have green mobility as quite large, and precision agriculture, health treatment, disease treatment, and also diagnostic to some extent. So yeah, we basically allocate our assets depending on at certain point of time where we see stock most attractive, along with which sub theme. But of course, we do have quite fundamental views about almost all the relevant sub-themes under the SDG framework, and we'll allocate the portfolio accordingly, depending on how the market moves.
Yeah, okay. And maybe just one final question then, Huizi, which is relating to our use of data, and how are we confident that sort of the data sources that we're using are accurate and make us confident in our judgments?
Yeah, that's a really good question. I think for our current investment process, data, of course, is extremely important, where we have an intention to measure the actual outcome coming out of each investment on their social environmental benefits. And I think our principle is that we stick with transparency. So given that, and we stick with the primary data as a main source, so we normally don't use estimates unless we are the primary data is lacking and we cannot reasonably make a second best proxy of that KPIs. And we try to use only select the KPIs that are proven to be material and relevant in relation to that specific SDG target. So it's not, we have to be very selective on what KPIs are used for what investments. And in cases where the data is really important but still lacking, we tend to talk to the company and try to engage with them and get more clarity around that.
Okay, fantastic. So with that, I think we will conclude by saying now that East Capital Group has 25 years of experience really working for positive change with ESG really top of mind throughout our investment process. And the fact that we're running 2 Article 9 funds today, I believe, really pays testament to the leading work we're doing in this field. Secondly, important again to mention the fact that as the world really accelerates the transition to net zero, sustainable funds such as ours are well positioned to benefit from the inherent growth of sustainable companies and deliver superior returns to investors. And finally, the regulation, of course, as Huizi mentions, is complex and evolving, but with an in-depth understanding of the regulatory requirements as well as a solid investment process, it is indeed possible to confidently run an Article 9 fund such as Huizi's. So with that, I'd like to thank everyone for taking the time to dial in today. Great to see such a large list of attendees, and I hope you've found it worth your time and interesting. And Huizi, many thanks for sharing your expert insights with us.
My great pleasure.
And please do reach out to either myself or any other members of the investor relations team in case of any further questions. And we're always glad to set up further calls with either Huizi or other members of our team. So with that, thanks a lot and see you soon.
Thank you.